Here on one side of this 100-yard field, we've got the good old Green Bay Packers. Now on the other side, we have one of their great rivals, the Chicago Bears. Whether it's these two football teams or any other, they have the same objective. When the Packers have the ball, they are trying to work through the Bears' defense to get to their end zone. And when the Bears have the ball, they're trying to work through the Packers' defense to get to their end zone. Now let's take that football field and turn it on its head. Let's shrink it down and plot it as a subchart. Still bound from 0 to 100. Here I have depicted the relative strength index. This indicator has been around for many decades, and it was put forth by Mr. Wells Wilder back in 1978. Now when he put it out there, he had a setting on it that we're not going to change, and that's the standard setting of 14 periods. In the case of this E-mini S&P chart, which is showing daily candlesticks, that means each RSI value is plotted based on the past 14 days. So we're going to keep the 14 period setting, but change pretty much everything else. The traditional approach suggests that when the RSI gets above 70, you're in overbought conditions, and this is where sell signals live. So here on TradeStation, my default indicator turns red. You can see these instances of this indicator turning red. Now this can be a problem when you're in a strong uptrending market because it might get you bearish too soon. The other angle to the traditional RSI is that when it falls below 30, it's considered oversold and buy signals live there. There's a great opportunity back here on this chart, but not so many after that. Yet the price trended higher. How would we have been able to take advantage of those moves using this momentum indicator? Well, when it comes to using only the standard approach to overbought, oversold, we're going to politely call BS and change things up. Remember the Chicago Bears, the Bears on the football field. They have to get to their end zone to make things happen. Well, it's the same thing for the market bears. When it comes to the RSI in a 14-period setting, they live in a certain part of this 0 to 100 range. The RSI bear resistance power zone, as I call it, is from 55 to 65. The bear support power zone is from 20 to 30. So the resistance power zone is where a downtrending or sideways market should get overbought. It should start capping out from 55 to 65, not up at 70. And the bear support power zone from 20 to 30 is where a downward market should get oversold. It includes the traditional 30 level, but by pushing all the way down to 20, you now have a greater cushion to observe that prevents you from catching a falling knife, as my dad used to say, which is trying to buy a sharp down move. Now these are the bear zones, and bulls have their own zones as well. The market bulls live in the upper part of the RSI field, if you will. The bull resistance power zone is from 80 to 90, so this is way above the standard 70 level. And the bull support power zone is from 40 to 50, so this is a higher cushion than the traditional 30 level provides. Together, the bull and bear resistance and support power zones allow you to amplify the use of this very commonly looked at indicator, giving you the ability to use it to trade not only when the market is sideways, but when it's also trending up or down. Using RSI power zones to identify trade setups, there are 3 steps that I'm going to teach you that we're then going to apply with real market examples. The first step is to review the chart and assess the price trend. So the chart could be of any market that you're trading on any time frame. And what we're looking for is to determine whether price is in an uptrend, downtrend, or sideways. Sideways is an option. After you've determined the price trend, it's time to evaluate the RSI power zones reading. What we're doing is looking at the RSI value relative to the 4 power zones that I just taught you. Lastly, we determine the presence of an entry signal between price and momentum. This can be based simply on the location of price and momentum relative to the power zones and the trend, but I'm also going to teach you a specific RSI power zone signal that you can start using right away. RSI power zones can be used for analysis and signals on any active market in any time frame. Let's start by taking a look at an individual stock on a daily time frame. Here we have the chart of Goldman Sachs. Step 1, review the chart and assess the price trend. We have a series of higher highs and higher lows in place, resulting in an uptrend. 2, evaluate the RSI power zones reading. You can see that the RSI power zones have been holding the bull support power zone, the two lower green lines. Step 3, determine the presence of an entry signal. Let's take a look at how price and then momentum are behaving. Price is making a higher high. But look at momentum. Momentum is making a lower high. There's a disconnect between price and momentum, and we can take advantage of it. When you see the situation of price making a higher high in an uptrend, but momentum making a lower high, this results in an RSI bearish divergence signal. Here, the RSI bearish divergence is taking place in a specific zone. We look at the location of the second high, and the second high is in the bear resistance power zone. So we have a bearish divergence in the bear resistance power zone. This is an offensive play. This is a situation where you should look to go short, depending on your risk-reward parameters. Here's the move that resulted just from this one signal. A high formed at 275.31, a low at 218.89. This was a $56.42 move, again, just based off RSI power zones and the presence of the divergence signal. We just looked at a daily chart, but now let's go ahead and look at an individual stock again, but this time on a weekly time frame. Here we have a chart of Baidu, again on a weekly time frame, so every candle is representing 1 week of price action. Step 1, review the chart and assess the price trend. We have an uptrend in price, higher highs and higher lows. Evaluate the RSI power zones reading. Take a look at these 3 instances of price and momentum. The RSI power zones are holding the bull support power zone. Price advanced and resulted in a consolidation period, or sideways action. But during that time, all the RSI power zones did was work off overbought conditions, moving from the bull resistance power zone from 80 to 90 down to the bull support power zone from 40 to 50. And during this time, once there was a price breakout, there was another disconnect between price and momentum. So when we determine the presence of an entry signal, we can see that price made a higher high, but RSI made a lower high. This again is the RSI bearish divergence, and again in the bear resistance power zone. So once again, it is an offensive play, and we can look to sell short. Here's the move that resulted. There was a high at 284.22, a low at 174.46. That's a move of $109.76, just based off this one signal using this one approach to the indicator. Let's move to a different asset class and take a look at an equity index futures on a daily chart. Here we have the E-mini Russell 2000 index futures, each candlestick representing 1 day. Review the chart and assess the price trend. It's a clear series of higher highs and higher lows. Evaluate the RSI power zones reading. The RSI power zones have been lifting up out of the bull support power zone with each pullback in the uptrend. Step 3 is to determine the presence of an entry signal between price, which is making higher highs, and momentum, which, as you can see, is making a lower high. This is again a bearish divergence in the bear resistance power zone. An offensive play with potential for a short trade. Here is the move that unfolded. Off the point high at 1751.30 down to the points base low at 1457.40, this move, when translated to dollars, was $2,939 in size. Again, just based off the application of RSI power zones and the divergence signal. Now, what happened at the end of this move such that it defined the end of the short trade? Well, take a look. There's a lower low in price, but a higher RSI value. When there's a lower low in price after a downtrend, but a higher RSI value, this is an RSI bullish divergence. This is what signaled the end of that down move. A bullish divergence in bear support power zone is a defensive play, suggesting that you protect your short positions. And based on the move that unfolded here, you can see that that would have been a great approach. So now you might be wondering, did Hima just give away the secret sauce? If I trade back and forth between RSI power zones, looking for divergences, will I make consistent profits? Well, it's like this. You were just provided and taught how to use a hammer and nails, if you will. Easy to